Attracting investment, the big game. You've gone from idea to MVP, perhaps even raised initial funds from friends or through crowdfunding. Your startup is starting to breathe, gaining its first users and revenues. Now it's time to think about scaling. And scaling, as a rule, requires big money. This is where angel investors and venture capital firms enter the scene. These are players who are willing to invest significant amounts in high-risk but potentially high-reward startups. Their goal is not just to profit from your product, but to see your company grow tens or even hundreds of times. It's a complex but exciting game, and you need to be prepared for it. Angel investors and venture capital firms. Who are they and where to find them? Imagine you're a young genius who invented something incredible in your garage. You have a prototype, enthusiastic early reviews, but to move from the garage to a real lab and start production, you need serious funding. Angel investors are like your first neighbors, friends, or simply wealthy enthusiasts in your community who heard about your idea. They believe in you personally, in your potential, and are willing to invest their own money. Sometimes even at the garage or basement level, when you only have a prototype and a burning ambition. They don't just give money. They often offer advice and share connections. Venture capital firms, VCs, are larger, professional investment corporations. They manage other people's money, pension funds, university endowments, large corporations, and are looking for the next star. That garage project that showed initial success and is ready for an investment of millions or even billions. They want to see that your garage is already transforming into a functioning company. Angel investors. Who they are. Typically wealthy individuals, successful entrepreneurs, top executives, former employees of large technology companies. They invest their personal money. Investment stage. They invest at very early stages, pre-seed, idea team, seed, MVP, first users. Amounts range from $25,000 to $500,000, sometimes up to $1 to $2 million. What they look for. An idea with great potential, a strong team. This is key for them at an early stage, a willingness to learn and adapt. Many of them don't just provide money, but also share experience, connections, and become mentors. Where to find them? Personal connections and networking. Often the best way. Attend startup events, conferences, accelerator demo days, use LinkedIn, ask for referrals from mentors or other entrepreneurs. Angel groups, art networks. These are associations of angels who jointly review and invest in startups, e.g., Tech Coast Angels, Golden Seeds. Look for them in your region. Angel List. The largest online platform where startups can create a profile and angels and funds look for projects to invest in. An excellent resource for initial contact. Crunchbase, a database of startups, investors, and funding rounds. Allows you to see who is investing in companies in your niche and find their contacts. Accelerators and incubators. Going through a well-known accelerator, Y Combinator, Techstars, significantly increases your chances of attracting angels, as they have already vetted your startup. Venture capital firms, VCs. Who they are. Professional managers who invest the money of institutional investors, pension funds, university endowments, large corporations. Investment stage. They typically invest at later stages, seed, Series A, B, C, and beyond, when a startup already has a validated business model, growth, and scaling potential. Amounts range from several millions to tens and hundreds of millions of dollars. What they look for? Above all, potential for exponential growth. They want to return their investments 10 to 100 times over. They are interested in metrics, users, revenue, growth rates, retention, market size, TAM, SAM, SOM, and a strong, scalable team. Where to find them? Crunchbase. Again, your best friend. Look for funds that have invested in companies in your niche or at your stage. PitchBook, a more expensive and in-depth database, often used by professionals. VC firm websites. Study their investment focus and portfolio companies. Don't waste time on funds that don't invest in your sector or stage. Networking. Getting an introduction through mutual acquaintances, other entrepreneurs, mentors, or lawyers working with startups is the most effective way to reach VCs. How to make contact. The most important thing is to get an introduction. Simply sending an email to a general fund or investor address is almost a guaranteed trip to the spam folder. Through mutual connections. Search LinkedIn for mutual connections who can introduce you. These could be other founders funded by this investor, your mentors, or specialists from accelerators. Targeted emails, only if no intro. If an intro isn't possible, send a short, highly personalized email. Show that you've researched their portfolio and interests. Explain why it's you and why it's now. And don't forget your pitch deck. Real-life example. It's said that the founders of Airbnb were rejected by 7 out of 8 investors during one of their early rounds. They were saved by networking and faith in their idea. At one point, they even had to sell Obama O's and Captain McCain's breakfast cereals at political conventions to raise their first $30,000. Subsequently, the investor who rejected them regretted it. So if you're rejected, it's not the end of the world. Preparing for the pitch. Your $1,000,000 story. Your pitch is not just a presentation. It's your story, told in 5 to 10 minutes. It's your vision of the future, packaged in a compelling form. The pitch deck is your battle map, the visual part of this story. For American investors, it's the most important document. What should be in a pitch deck, typically 10 to 15 slides. Title. Slide. Company name, your logo, a short and catchy slogan. Problem. Clearly and concisely describe the problem you are solving. Use data to show how large and painful it is for your target audience. Show that you understand the customer. Solution. How does your product or service solve this problem? Show, don't just tell. Use screenshots, a short video demo of your MPV. Value proposition. Why is your solution better than what currently exists? What makes you unique? Market size, your TAM, SAM, SOM. Show the investor that you are operating in a large and growing market. Investors look for billion-dollar markets. Business model. How will you make money? Your revenue streams, pricing strategy. Go-to-market strategy, GTM. How do you plan to acquire customers? Your marketing and sales channels, competitive analysis. Who are your main competitors? What are your advantages over them? Don't fear them. Show that you've studied them. Team. The most important slide for early investors. Who are you? Why are you the one to do this? Show relevant experience, competencies, unique abilities. Investors invest in people. Financial projections. Your revenues and expenses for the next 3 to 5 years. Break-even point. Be realistic, but show ambition. Traction. What have you already accomplished? Number of users, revenue growth, key partnerships, awards received. This is your proof that you can deliver on your promises. Ask. How much money are you seeking? What will you spend it on? What milestones will you achieve with this money? This should be very specific. Contact information. Pitching tips. Tell a story. People love stories. Make your pitch an engaging narrative. Focus on the problem and solution. The problem and solution slides are the most important. Make sure they are crystal clear. Less text, more visuals. Investors don't want to read miles of text. Use graphs, icons, large fonts. Practice, practice, practice. You should know your pitch by heart. Rehearse in front of a mirror, friends, and family. Be ready for questions. Investors can ask many questions. Know your numbers, your assumptions. Be prepared to defend every figure and every statement. If you say, our market is $10 billion, be ready to explain how you arrived at that figure. Deal terms, term sheets. The devil in the details. A term sheet is not a legally binding contract, although some clauses may be binding, but a summary of the main terms of a future investment deal. It's a roadmap for lawyers who will then draft the full investment agreement. It's important for you to understand the key concepts. Common stock. The stock usually received by founders and employees. They have voting rights, but in case of company liquidation, they receive payouts last. Preferred stock. The stock usually received by investors, angels, VCs. They have several advantages over common stock liquidation. Preference. In case of a company sale or liquidation, investors get their money back first, usually their original investment, sometimes 2 to 3 times more, before other shareholders receive anything. This is their protection. Protective provisions. Investors may have veto rights over important company decisions, e.g., company sale, charter changes, raising new debt. Anti-dilution provisions. Protects the investor from a reduction in the value of their shares if the company raises money at a lower valuation in the future. Participation rights. Investors may receive both liquidation preference and then participate in the distribution of remaining profits along with common shareholders. Why is it important to know this? Each of these terms affects what share you, as a founder, retain in the company, and how money will be distributed in case of a sale or liquidation. Don't hesitate to ask your lawyer and financial advisor questions until you understand every term. Signing a term sheet is a very serious step. It's like agreeing to participate in a reality show without reading the entire contract. And then you find out you'll have to live with a goat in one room because it'll boost ratings. It's better to know this before the show starts. Legal aspects of attracting investment under SEC scrutiny. The world of investment in the USA is strictly regulated to protect investors from fraud and ensure transparency. The U.S. Securities and Exchange Commission, SEC, is the primary regulator that oversees this market. What's important to know? Securities Act of 1933 requires that any securities, stocks, bonds, equity, and companies be registered with the SEC before they are offered to the public. This is very expensive and complex. This is what companies do before an IPO. Exemptions from registration. For startups, there are important exceptions to this rule that allow them to raise capital without expensive and lengthy SEC registration. These are your best friends in the early stages. Regulation D, Reg D. The most common exemption. It allows you to raise money from accredited investors, people with high income or high net worth, as well as institutional investors. Most venture investments and large angel deals happen under Regulation D. Regulation crowdfunding, Reg CF, or Title III. We already discussed this. It allows you to raise up to $5 million from non-accredited investors, ordinary people, through specific platforms. Requires certain disclosures to the SEC. Regulation A, Reg A, allows you to raise up to $75 million from both accredited and non-accredited investors, but with a much more complex disclosure process, similar to a mini IPO, for later stages than early ones. Risks. Non-compliance with SEC rules can lead to severe penalties, lawsuits, and even nullification of the deal. Tip. Never try to raise investment without a qualified lawyer who specializes in startups and understands securities law. This is not an area where you should cut corners or try to figure things out yourself. Your lawyer will help you properly structure the deal, prepare all documents, and comply with all SEC requirements.